Are you considering buying a home in 2022? Maybe it's a goal that you put down or perhaps a resolution of something that you want to accomplish this next year, and you're wondering what the outlook is for real estate. Are we going to see record appreciation like we did last year? What are interest rates going to look like? Well, we're going to talk about all of that. In today's video, I'm going to tell you why I believe you're going to continue to see strong housing, why you're going to see another strong year of appreciation, and why a housing crash isn't realistic in our current environment. We're going to talk about everything from interest rates to income and job growth, foreign buyers, and all things that make up a housing market to give you an idea of what to expect if you're planning on pulling the trigger and buying a home in 2022. My name is Jeb Smith. I am a real estate broker here in Southern California, but the goal with this video isn't to get you to purchase a home, is to give you enough information so that you can make informed decisions on your side about purchasing a home or not purchasing a home, whether you should wait or whether you should buy now. And another thing to remember while you're watching this, all real estate is local. I primarily talk about what happens in my market here in Southern California, but you can apply these principles, the same things that I'm talking about to any market out there at the moment to make informed decisions. Another thing I'll tell you is that if a housing market did really well in 2021, there's a very good chance you're going to see that market do well in 2022 because the fundamentals aren't going to change. The very first thing I want to talk about in today's video, and one of the key drivers of the market at the moment, is demographics. We have 72 million millennials out there as, a generation. And that generation has just started to become prime buying age over the last couple of years. And that prime buying age is 33 years old. And now you're sitting there wondering, well, how are millennials affording property, with the increases that we've seen? Well, a lot of these millennials have lived at home a lot longer than any other generation. They've been able to save money during that time. In addition to that, they've also had better paying jobs than a lot of us did when we were younger. And therefore, they have an opportunity to come into the market and start buying real estate. And it's something that millennials want to own. And as they continue to turn prime buying age, you're going to see more and more millennials purchase property. This is going to happen for quite some time. Now, this is just one key piece of the puzzle, but it's a large piece because they make up a lot of first-time home buyers out there. In addition to the savings that they have, a lot of their parents and grandparents are now taking money out of their properties. Their grandparents are giving inheritances early. I'm seeing it with my clients. They're passing along this money prior to death. A lot of this money would have gotten passed along at some point in the future, but they're pulling it out of property now, taking it out of trust now, passing it along to give that generation an opportunity to purchase property before prices continue to increase. A lot of people out there believe that real estate is going to increase over the next couple of years, and they see home prices continuing to rise, and they feel if they don't help, that younger generation get into property now, they might miss that opportunity. There might not be an opportunity in the future as those prices continue to grow. And that's just one piece of the demographic pool. You also have foreign buyers. Over the last couple of years, foreign buyers haven't really been a threat to our housing market because of all the restrictions put on travel. A lot of these potential investor foreign buyers haven't been able to purchase in the United States. In fact, a lot of them haven't even been able to travel to the United States for that matter. Over the last couple of years, we've had a huge influx of Canadian buyers coming into Florida and the southern states because it's a warmer climate. And those buyers over the last year and a half haven't even been able to come into the United States, much less purchase property. And so what you're going to see as things calm down with the pandemic, as we get over this virus, hopefully eventually, in the first half of 2022, you're going to see more of these foreign buyers continue to come into the market and purchase property, which is going to take away that supply. Demand is going to be there, and it's going to put further stress on housing, likely sending home prices up. At the same time, you've got institutional buyers. These are the big, funds out there that are putting pension funds and other additional assets into real estate because it's a fixed income. As we see inflation numbers rise, which we're likely going to see at least the first half of 2022, you're going to see more people take money out of volatile asset classes and move them more towards fixed income so that they know every single month how much income is going to be generated. And this is going to be seen primarily in institutional buying. A lot of these funds out there want to be able to provide a fixed return for their clients, and the best way to do that is put it in real estate. Not only is it the best hedge against inflation, it also gives them an opportunity to know exactly how much income they're going to be bringing in over the course of that year, in addition to gaining equity in those funds or in those properties during that time. While I know a lot of you are looking to purchase property and likely don't follow the rental markets that closely, the rental market is as crazy as the buying market, as the buying and selling market out there. It is very, very difficult in a lot of markets out there at the moment to find a good rental at a reasonable price. Most of these rental properties, the prices have continued to go up and up and up over the last year, year and a half during this pandemic. And at the same time, it's becoming harder and harder to find these properties. I've actually looked at rentals myself, because my wife and I, we want to purchase another property, but we don't want to sell the property we're in. We've actually considered renting our property and even, had the thoughts of going to rent something else while we look for that property. And honestly, we can't find anything even close, even remotely close to what we would rent for a reasonable price in our market. It's just nuts out there. And at the same time, I have investors, out-of-state investors, even in-state investors that are buying property here locally and renting it out at a loss every single month because they want that fixed asset. They're taking their money out of volatile things like stocks and putting it into a fixed asset like real estate because they see real estate prices continuing to rise over the next year, 2 years, potentially 3 years, and they're looking to take advantage of some of those gains. And because of that, it's going to continue to put stress on supply, right? At the moment, depending on who you're watching, what you're reading, the country is somewhere between 4 and 6 million homes behind with regards to where we should be with building. And at the moment, we've got rising building costs, we've got restrictions on builders in certain areas, we've got land selling at a premium. It is very difficult for a lot of these contractors to continue to build property at a rapid pace. What we'd like to see is these construction companies, these builders build 1.5 or so million homes a year. That's pretty average. So it would take approximately 4 years in order just to make up the gap in the lack of supply that we have on the construction side, which is only a piece of the puzzle. At the same time, you've got boomers, right? The baby boomers who were supposed to be selling their property, they were supposed to be aging out, as they got older, continued to live longer than anyone thought. They wanted to stay in their properties because they're looking at the market and realizing that, what they have to purchase or the opportunities that are out there for them to purchase are much less desirable than what they have and much more expensive than anything they want to spend. And therefore, it makes more sense for them to stay in those properties. So those boomers aren't selling property. Construction cost is keeping, new construction from really thriving. And at the same time, demand is going through the roof, partly because of millennials that we mentioned earlier, but it also has to do with low interest rates. At the beginning of the pandemic, the Fed lowered the Fed funds rate to 0 and said that they were going to start buying mortgage-backed securities and bonds, and that caused interest rates to go low. And they stayed low and they continued to move lower. And, only recently have we seen really, any sort of rise in rates, but even then, it's minimal. We're still seeing rates in the low 3% range, even the high 2% range, depending on what type of loan you're getting. So interest rates are still very, very good, especially historically. And even though the Fed is going to raise the Fed funds rate this year, and they've said that they're coming out and they're going to start to taper, the mortgage bonds and the mortgage-backed securities, and that's going to end by March, the reality is interest rates can't really go that far, regardless of who out there is predicting 3.75, 4% interest rates. Yeah, predictions are great, but I can tell you a lot of these organizations out there that are calling these rates have been predicting this over the last couple of years, and they've been wrong every single year. And so the majority of people out there that actually know what they're talking about are thinking interest rates are going to fluctuate somewhere between 3.375 to 3.625 on the high side. And there's even people out there that think that you might see interest rates at 2.375 to 2.5% on the low side. And something else that we've talked about, multiple times on my channel is that, the Fed, the Treasury, makes their payments on their debt, which is going to be somewhere around $31 trillion here in the next year or two, based on where interest rates are. So if interest rates continue to rise, that means they're going to be paying more money to service their own debt. We already don't have the money to service our own debt. And so by raising interest rates and raising the Fed funds rate, it's going to cost them potentially more money to service that debt, which is going to put us further into a deficit because we don't have the money to pay it, which creates a whole nother issue. So at the end of the day, the Fed can't do but so much. And the main driver of the housing market, as many of you know, if you watch my channel, talk about it all the time, supply and demand, right? Until demand exceeds supply, you're going to see housing continue to be very, very strong. In fact, supply is at the lowest level in nearly 30 years. And at the same time, the median homeowner tenure has gone from 4.5 years to over 10 years. So the average person right now owns their home over 10 years. Whereas before, it was a shorter period of time, so you saw homes come on the market a lot sooner. Now people are staying in their properties. And because a lot of them have record appreciation, they have super low interest rates, low payments, it doesn't make sense for them to sell property and buy something else, especially if you're in a state like California where your property taxes are based on your purchase price. Because by purchasing something more expensive, your payment is going to go up considerably based on where home prices have gone up. So supply isn't really going to change very much, which only adds fuel to the fire and creates more stress on buyers out there with less opportunities to choose from in the big picture. Now, if you're watching this and wondering what can you do to set yourself up for success, what should you do to be in a position to buy a home, so when the right home comes on the market, you're in a position to make an offer, the very first thing you need to do is talk to a mortgage professional, go through the pre-approval process. And I'm not talking about pre-qualified. That means calling someone and just going over stuff over the phone and not providing any documentation. I want you to provide the documentation. I want to have them run your credit score, provide your W-2s, provide your bank statements. Let them look at everything and tell you exactly how much you can afford to purchase. That way, you know exactly where you stand. You're not guessing, wondering, can I do this or can I? You know exactly where you stand. You know how much home you can purchase. You know what your payment would be based on today's interest rates at those prices. And that gives you a surety knowing that you can actually do it. That's the number one step. Now, if you're wondering, how do I get in touch with a mortgage professional? I put a link below. Click on that. I'm happy to refer you to somebody that can guide you in the right direction and also able to connect you with a real estate agent as well. And if you're continuing to watch this, wondering, what the housing market's going to look like in 2022, I dive into it in another video here in a little bit more detail and some changes that I think are going to happen. So check that out. Let me know your thoughts in the comments below. But for now, I appreciate you taking the time to watch. I appreciate all the support. Hope to see you again soon. Have a great day. Bye-bye.